Okay. We'll open up the public hearing on Senate Bill 25 and hear from the prime sponsor, Senator Innes. Good afternoon, Senator.
Good afternoon, Mr. Chair, members of the committee. It's my pleasure today, Dan Innes from Bradford, representing District 7. It's my pleasure today to introduce Senate Bill 25 to you. And this legislation is pretty straightforward. As most of you probably know, board members for corporations are normally compensated at some level, varying amounts depending on the company and the industry and so on. One exception to that is credit unions in the state of New Hampshire. And this legislation comes to you through me at the request of the Cooperative Credit Union Association of New Hampshire and the New Hampshire Credit Unions themselves. And believe it or not, New Hampshire is home to the nation's first credit union, St. Mary's Bank, founded in 1909. And what this legislation would do is bring us up to speed with 16 other states that allow membership in state chartered credit unions to vote to allow compensation of their board members. And really, the job of a credit union board member isn't dissimilar to a bank board member. And it requires more work and higher levels of expertise today than it has in the past. And it's important that you have a good board to ensure compliance and good governance and so on. So compensating board members for their time makes sense. We're compensating them for their time, for their expertise, and it'll help credit unions to get better quality candidates on their board and ideally make better decisions going forward. Nothing in this legislation would force a credit union to compensate board members. It's enabling legislation only. And I'm happy to take any questions you may have, but there are also a number of folks behind me who I know can address these matters as well.
Representative Burrows.
Thanks for taking my question. I'm just curious as to why in the past the credit union members were excluded from the enabling.
It's a great question, and I could make an attempt to answer it. I'm going to let these folks do it, but if I were to hypothesize, I would say that it's because credit unions typically have had a nonprofit and do have a nonprofit mission. I think that was probably the rationale behind it. Yeah.
Representative Spear.
Thank you. I'm just out of curiosity, what kind of compensation are we talking about? I mean,
I'll let the credit union folks answer that, but normally it's not too much. You know, I mean, we're talking, fairly modest sums in most cases. The larger, if you look at banks, for example, the larger the bank, or if it's a mutual versus not, there'll be differences in compensation, but that it's all over the place. Major corporations, it can be a lot of money, but credit unions in our state, I think it'll probably be a pretty modest figure. And I'm kind of looking back at folks. Yeah. I bet it's $100 a year. Yeah, or maybe $100 a meeting, something like that. Yes. Okay.
Thank you very much for your
All
testimony.
right. Thank you.
Chair will call on Ken Zenos and Adrian Vasquez.
Good afternoon. My name is Adrian Velasquez. I serve as the Chief Advocacy Officer for the Credit Union Association. Before I begin my testimony, I actually want to answer your question, Representative, and I want to address why is it that in the past, credit union were excluded from compensation, and in part is because of the non-for-profit status. We want to make sure that we stick to that ethos of volunteer, of public service. However, with times changes and with rapid technology implementation in many of our financial institutions, we believe that this will allow us to attract new talent, which I'm going to speak. And the type of compensation for Representative Spear is that we're not talking about salary. We're talking about anything from I would say anything from daycare to compensate someone for a course on cybersecurity or accounting, anything that advances the mission of the credit union and the financial institution. With that, thank you very much. I'm happy to answer more questions as they arises. I'm here to testify in support of Senate Bill 25. The bill would allow state chartered credit unions in New Hampshire the option to compensate their board members. New Hampshire credit unions are more than financial institutions. They are the lifeline of 800,000 members and the cornerstone of our local economy. With an impact exceeding $1.1 billion, but perhaps more inspiring is their strong commitment to giving back. For decades, they have stood proudly with Make-A-Wish New Hampshire, raising over $3.8 million to bring hope, joy, and life-changing experiences to children facing critical illnesses. This legislation represents a vital step to align New Hampshire with 16 other states that recognizes the increasing responsibilities and expertise required for credit union board members. Board member compensation will ultimately benefit credit union members through enhanced governance performance. It is important to emphasize that this legislation is purely enabling. It does not mandate compensation for board members, but instead empower credit unions members to decide for themselves. It is optional. This approach respects the cooperative structure of credit union, ensuring decisions are made democratically and in the best interest of members. Credit union director compensation remains modest compared to fees paid to director of other financial institutions. More importantly, providing fair compensation ensures that credit unions can attract and retain talented leaders who can navigate the complexities of today's financial landscape in an increasingly competitive professional climate. A couple of states have moved forward with this type of legislation, 16 in total. Tennessee and Washington are the most recent state to adopt similar measures. Notably, in our area, Rhode Island, all state charter credit unions offer compensation to their board members. Understanding the rapidly changing business environment, the option of credit union board compensation is a growing trend in our country. And in conclusion, I respectfully ask you for your consideration in support this legislation to allow state charter credit unions to compensate board members to strengthen their governance performance and to remain competitive and attractive talent. I want to pass it to my colleague, St. Mary's Bank CEO, President Ken Sinos, who will speak further on his experience with board member recruitment and retention. Thank you.
Thank you, Adrian. Chairman Hunt, members of the committee, I am extremely grateful to be able to present and testify over today on this Bill 25. It really hits home because we live and breathe this every day with our directors. And in my role, I'm working hand in hand with our chairman, our vice chair, and our directors, whether it's on our board meetings themselves or several committees. So I'm here to answer questions and also just give a little bit of insight as to some of the responsibilities of our directors. You know, we talk about cybersecurity or talk about the biggest topic right now is our asset liability risks and modeling to make sure that we have ample liquidity and we have ample capital. There's so many complexities in the credit union system right now, similar to the banks, that we're asking a lot of our directors. You know, I'm just going to give you a spotlight in the day of one of our directors. You know, we have continuing education so they could stay abreast of the current topics in the banking and credit union world. You know, we bring them to conferences so they could meet and interact with other directors, get other ideas what other financial institutions are doing. Committee meetings. So in addition to our monthly board meetings, each director volunteers to get signed up for 1 or 2 or 3 different committees within the board structure. Just an example of some of these committees, we have a supervisory committee that oversees all audits. We have a compensation committee. We have an asset liability committee, an IT steering committee, a pension committee. There are so many committees and responsibilities of these directors. And in addition to just attending the meetings, they come prepared. So there's lengthy packages that are put out on a board portal before every meeting that they have to study, understand. We have questions. I know just our board meeting, we have multiple discussions before our budget every year, so they could understand what's going on before they have to, you know, sign off on that annual budget. So there's a lot. One other, you know, aspect that I can address. Before coming to New Hampshire 8 years ago, I was with a credit union in Rhode Island who they did have the state legislation to pay their board members. And I just want to echo Adrian's comments on attracting qualified board members. but also retaining the board members is huge when you can have a compensation of some extent. You know, you look at the changing and evolving membership of our credit unions, and you know, you're trying to get some of the younger demographics. Well, you want a board, you want representatives on your directors to also have, and they could relate to our evolving membership. These individuals are growing their families, they're growing their careers. Time is at a premium. So if we could help retain them, and at St. Mary's, we allow our directors 5 3-year terms, 15-year commitment. And I have to say, talking to a few directors, until they're into like mid-second term, they're really starting to get gelled with what's going on in the credit union movement. What are the important things? How does asset liability management work? It takes time, and we want to be able to retain these directors once we build their knowledge. And this bill would allow us to help the credit union directors stay and flourish. So, you know, my final thing would just be, you know, in closing, you know, we being the first credit union, it's kind of cool that we started right here in New Hampshire. We can't do things the way we did them in 1908 and 1909. We got to continue to evolve. This bill is helping the credit union laws continue to evolve here in New Hampshire. So I would just ask that you please try to look at supporting this legislation.
Thank you. We're welcome. Any questions you might have?
I do. Yes, Representative Burrows?
Hi, another quick question. These paid directors, do they have to be members of the credit union?
They absolutely do.
Okay.
They have to be members of the credit union, and they have to be elected by the members of the credit union as well.
Right. And to Ken's point, I think something that I want to emphasize is that the membership decides if the board members get any sort of compensation. This is not going to be the board members deciding for themselves, but rather the whole membership in the annual meeting. So St. Mary's Bank have their annual meeting coming up very soon. They can, if the legislation were in place, they can all decide that this is the way that they want their governance to be compensated. Thank you.
So, yeah, I did see that in the language of the bill. So, and I apologize, I'm asking these questions. Now, normally I would do my homework ahead of time, but I had some other bills that are Senate bills that are taking up a fair amount of my time. How many, or what's the percentage, or what's the? I mean, every credit union I assume is different, but of how many of these let's say non-company employees? Because I see you can't be somebody who's already within the bank. It has to be, this is an outside board member. So what is normally the percentage, or how many are there usually on in boards?
I mean, it can vary. That is determined by the credit union bylaws.
Bylaws, correct.
Overall, I would say if we need to guess somewhere between 7 and 11, that varies. That would be
Out of how many?
the board composition. Are you asking me about the board
Well,
composition?
let's take your board.
Right.
Just
Yeah,
take your
so-
board. How many board members do you have,
Yep.
and how many are who would be eligible for this benefit?
Yep, currently today we have 10 board members,
10.
and we have a supervisory committee. We have 4 additional 4 supervisory committee directors.
So you have 4 that would be called
That would be part of the supervisory in this
non-employees,
bill as well. Correct.
okay, so there's 4 of these. And is the vote done by proxy? In terms of voting the board members, is it done by proxy?
So in terms of the vote, that is basically determined by each credit union charter.
Right?
I haven't seen many charter that allows voting by proxy, because there is an annual meeting requirement which people have to be present and vote. I think there was an exemption during the pandemic. However, as it is right now, it is not necessarily allowed for voting by proxy unless the bylaws of each credit union change that, but that would require ultimate voting.
Yeah, I'll go into how we handle it, because we actually have our annual membership meeting tomorrow night. We have ballots in our bylaws, in our charter. We have an allowable period, and it's like 60 days or 90 days that we have to get out to the membership as to when our annual meeting is. And then we have a period of time that we actually put out ballots for any decisions, voting that needs to take place. So, we communicate it to our membership. All of our branch locations have ballots there, so the members can fill them out, mail them in, send them in, self-addressed stamped envelope. So we are always out there with the ballots, trying to give them to our membership so they could sign them and return them for the voting. So we don't have to be present at St. Mary's Bank for the meeting. They can just mail it in.
And so this would be an article in that proxy, in that,
It would.
that particular meeting, what the compensation would be.
Absolutely. It would be in there. And I know that's how it was handled in Rhode Island as well. They would vote on any new directors, and then they would vote for any kind of compensation for any directors. And it would be all specifically.
So would the
highlighted.
initial vote be whether they want to pay or not pay?
It would be.
There
It
would
would
the
be.
initial warrant, I call it warrant, but the initial proxy question would be, do you want to have paying compensation or not?
We'd actually specify the amount.
Right.
So we would actually say the vote would be for paying each director a sum
Okay.
of X per year or per meeting for the motion would be.
And,
Okay.
and in part, that is if the compensation is monetary. There could be other type of compensation, like educational reimbursement, for instance. So there will be a disclosure in advance in cases in which the bylaws allow, but for the most part, not every credit union has voting by proxy. It is determined necessarily by their bylaws.
So how about federally chartered banks, chartered credit unions?
So under the Federal Credit Union Act, the distinction would be that the Federal Credit Union Act allows only one board member to be compensated, and the remaining one has to be volunteer. This is a little bit from the Federal Credit Union Act, because certainly under these circumstances, if the bill were to be passed, then we would allow, then the credit union can make that determination of how many board members can be compensated.
Do you do 990s, or what is your?
We do.
You do 990s, because someone who is a treasurer of two nonprofits, they care a lot about board member compensation on that return.
Yep. And it would all be reflected.
So it strikes me is that this is a very unusual request to compensate board members of a nonprofit. But you're saying Rhode Island did pass this.
Yeah. There's like 16 states.
States have
that do
passed
that,
this, and they allowed it for all non-employee,
yeah. All
all
director level.
directors, whereas the federally chartered
Allows for one.
is only one. Okay, I guess maybe we'll have to. All right, so Representative Semin Ammon.
Thank you for your testimony. I just wanted to get some background. You mentioned the year 1908. It's been a long time.
been a
since
long
the
time.
First credit union, St. Mary's. What's the justification for not compensating in the last 120 years? Why wasn't it allowed for in all that time?
I don't have the history on the legislative side of it as to why. It never went anywhere with the government for years, and I'm not sure why it's been picking up traction. I think the sophistication of what we do, and I think when you're looking years past, some of the credit unions were in the basement of the church. You know, we started with St. Mary's Parish. Now we're getting to be more community oriented. The larger the institution, the more complexity. It used to be everybody would do their banking walking into the building. Now it's all digital, which now you got to look at all the IT controls and security and all that side of it. So what we're asking of the directors, it's getting more and more complicated, and asset liability, it's never been more important than it is now. So all those types of things, I think it's just getting to the point where it's morphing into such a complicated environment. We're competing with a lot of the board members that are now they can easily go to one of the community banks and get compensated and get stock options. So it's a little bit different on the credit union side, trying to get and retain that talent.
Representative Salvis.
Thank you for taking my question. I have two questions. First one is whether the members' voting is confidential, or when the member votes for the
It is confidential.
confidential. And the second one is whether you guys have some kind of a policy in place that what will be the range of the compensation based on the experience, and that will be used all across the board?
It would be. And again, this is, since we can do it right now, we don't really have that policy, but it would most likely be addressed based on how engaged that director is. Like how many different committees are they on? Are they on multiple committees, or are they just a standalone director? But it would be a consistent across the board.
Okay, so the policy will be there. Thank
It
you.
would be there.
Credit union as an industry, they are very heavily regulated, and for the most part, when it comes to protocols, they are required to have these policies in place because the primary concern of regulator or the state in this matter is safety and soundness. And for that purpose, we want to make sure that we have plans and that we are abiding for certain protocols. So the presumption will be that there will be some sort of like policy in place. Obviously, for accountability as well, it is important to have that.
Thank you.
Not that I want to pick a fight or anything, but every proxy I've ever gotten has my name and exactly how many shares I'm voting on. So how is that?
I'm sorry.
How is that not going to be noticed by the person who's counting the ballots?
Well, from the counting the ballots, yes. When we say confidential, we do, but then we don't share that with anyone. It goes to risk. They verify that it's a member because we want to make sure that it is actually a membership. But then it gets ripped off, and the vote side of it goes
So
to.
that's not confidential.
Well, yeah.
I do have a story I'll tell someday. Representative Shariza.
Yeah, thank you, Mr. Chairman. Actually, my question actually follows towards Representative Salvi. So based on the presentation that you've given so far, it seems like the purpose of this is to allow some kind of modest compensation to the directors. So in that case, do you have any ceiling or do you have any max that the compensation cannot exceed that?
The way the vote would be written, which I'm used to in Rhode Island, is that's exactly it. That it would be the board members could get paid up to a maximum of X per year that the membership would be voting on.
So will that be on the bill? That there will be a
Yes,
max
they did
ceiling?
state earlier that that would be the vote. When
would
it's
be the
voting on, there would be a dollar amount so that the person
Exactly.
who's voting knows exactly how much they're going to be compensating.
No, the max, because I don't see that
No,
in
I'm
the,
saying,
in the language.
I know it's not in the statute. He's saying as a policy that when that proxy motion, we could put it in here, but he's saying is that they're going to do that anyways because that's the way Rhode Island did it.
Okay.
I think
Thank you.
it's also important to remember that the main purpose of credit union is financial empowerment to their communities. It's not necessarily to become rich. So there is a level of measure when it comes to compensation, including for people that actually work in the credit union, right? Like if you compare from credit unions to bank, compensation are not nearly as similar. Similar here, if this bill were to be passed, when we're talking about modest compensation, we're not necessarily talking about a salary per se, but we're talking about more, can we pay for this course that it will be helpful, like cybersecurity, or can we compensate someone? Let's say we have a solo practitioner attorney that doesn't really have doesn't have the wiggle room to be in the board meeting, but this might allow them to be in the board meeting, and that would be helpful because that complement a part that we have missing in our board. So that's our approach. But I appreciate the question, and I think ultimately that can be determined via rules. And
Yeah, I just want to make
rules
sure
and
that
common process.
there is no
Further question?
Further question. Sorry. So I just wanted to. Is it fair to say that don't want to get into a rat race of okay, to attract talent, some other bank is giving this much, let's try to give more than that, and then basically there is no upper ceiling is maintained or monitored by some
Yeah, no,
agency.
no. Again, from my perspective.
You
yeah.
take the microphone, sorry.
Sorry. From my perspective and my experience, we can't compete with what the banks would be paying the directors, and we have been very lucky in getting very qualified directors up to this point. It's retaining them and getting younger directors, and retaining them for the future. So, is it going to be as high as some of the banks? Absolutely not. It will be fully disclosed to the membership. The members would be voting on the maximum compensation that would go, but it would really help us as a credit union to just get in a little bit more in aligned with getting the right skill sets for the board.
Thank you.
Seeing no more questions, thank you very much. Is there anybody else who would like to testify
Thank you very
on
much.
Senate Bill 25? Seeing none, we'll close the public hearing on Senate Bill 25. And moving right along, Senate Bill 26. The definition of deposits as they pertain to land sales and escrowed accounts. And Senator Pearl is armed and ready.
I think so. Good afternoon, members of the Commerce Committee. For the record, my name is Senator Howard Pearl, representing District 17, and I live in the beautiful town of Loudon. I am here today to introduce Senate Bill 26. For decades, builders have accepted funds from buyers for upgrades and luxury items not included in the base price of a home. These funds were used to cover the cost of ordering and the installation of those specific upgrade items during the build of their home. Recently, the New Hampshire AG's office has classified these funds as deposits and requires that any funds for upgrades in subdivisions with 10-plus condominiums or 15-plus single-family homes be held in escrow, fully refundable to the buyer. This change leads to three issues. Builders must absorb the cost of upgraded items, and if a buyer backs out, either taking a financial loss or raising home prices to cover the risk, therefore making new homes more expensive. Second, even if the buyer does not back out, the builder still has to pay for these upgraded luxury items themselves during the build of the home, increasing their carry costs and ultimately contributing to higher home prices for the buyers. And thirdly, some builders are limiting buyer choices to avoid the financial risk of installing buyer upgrades without access to the funds, potentially driving buyers to other subdivisions that don't have these requirements and/or limiting buyers' choices in the build of their new home. So this proposed legislation would clarify that while escrow deposits for the purchase and sales agreement are held in escrow until closing, funds for upgrades and luxury items can be paid directly to the builder and used in the construction process without being held in escrow. The consumer is made fully aware by signed disclosures that any monies placed for specific upgrades to a property are made at their request and specifications. Any monies used to personalize a property are at the buyer's risk and expense, and those dedicated funds will be used to personalize their home solely. If the buyer cannot get their financing or if the deal falls apart prior to closing, those funds are non-refundable. The buyers sign a very clearly stated addendum stating they understand the risks and choose to personalize their property. Legal-aged adults are signing an addendum being made fully aware that their personalization comes at a financial risk. So I thank you for the opportunity to present this bill to you, and happy to take any questions. I do know there are representatives of the Home Builders Association here, which maybe will answer your technical questions better, but I will do my best.
I guess this one I did read ahead of time. So
Well, you are a
you said
co-sponsor.
the
so-
AG, the AG, it ruled that in terms of escrows were supposed to go to the escrow deposit account. But what is stopping us from a builder doing this right now, having this separate piece of paper and say, these changes that you're requesting are non-refundable?
My understanding is they can't. I'm not sure that I can tell you why they can't, but it is my understanding that they cannot do this without this legislation.
So you can explain to us why they can? Okay.
Seems a good answer.
Okay, that was all I needed to know.
All right.
We're all set.
All right. Thank you.
And you are?
Good afternoon. Alex Monastero. I'm here representing the New Hampshire Home Builders.
Okay, great.
So Senator Pearl covered a lot of what I sent in my written testimony this morning, but essentially this is just a fix to a problem. And to answer your question, it's a recent ruling by the AG in the way that they interpret their own rules, which says that any additional deposits should be considered as escrow deposits and need to remain in an escrow account. So the way that the rules are written has not changed in the last few decades. It's just an interpretation from the AG's office that that is how it should be interpreted. And so we've worked with them to come up with this language. As far as I know, they are in favor of this language, enabling them to allow us to put upgrade dollars separate from earnest money escrow deposits.
Okay, that'd be great. Can I get a copy of those letters so we can, if is that possible, that these AGs, A, their opinion, and B, that their agreement with, that they're okay with this language.
Yeah, I'll see what we have. I know we've had a lot of conversations in person with them, but we can certainly reach out and see if we can get an opinion from
Yeah.
them. Sure.
I'm a little shocked that they did this, but you know, that, there it is. Okay.
Yeah, in a real life example, just to compound on what Senator Pearl said, is if I go into a community and I want to build a house and the standard is a fiberglass shower, but instead I've decided, I've always dreamed and saved to have a bright pink tile shower. In order to do that, in decades past, in many years past, I would just pay the extra money to have that pink tile shower that I've been dreaming of, and the builder would install it. And what happens now, because the way that they are interpreting their rules, is that money has to go into an escrow account. It cannot be used by the builder to install the shower. And then if I back out last minute, the builder is stuck reselling the home with the pink shower.
Well, but the simple point is that they have to order the pink tile, and it might take a long time to order it. So they got to order ahead of time, and they got to prepay. Usually the tile company's not going to just let that tile away for free. So
That's right. So the
I'm-
builder is fronting the
I'm
money.
kind of shocked that they would, but is it because they're fearful that the whole thing might go south, the whole transaction might go south, and therefore now we're focusing on the deposit or the escrow money?
So my understanding, I certainly don't want to speak on their behalf, but in conversations that I've had with Attorney General J.R. Davis, who is a representative of the AG, is what their concern is the builder not delivering. The money becomes non-refundable. They've given the, let's say, $5,000 to put the pink tile shower in, and then the builder doesn't ever deliver it, and they're out that money. It's gone. They've left. And I think that's primarily a problem we see with, Joe Builder, who pulls up in his truck and says, I can put a tile shower in for
Right.
you, not in a sophisticated Attorney General approved subdivision by a builder who's building 15 plus homes.
Yes. I think we're all familiar with the gypsy asphalt guy.
Yes.
All right. Thank you very much. Is there any questions from the committee members? Yes.
Got a
Reverend-
quick question, but the way I read the bill, that this extra escrow or deposit, it can be negotiated. So in other words, the builder could require them to actually pay up front or make an escrow deposit. So this isn't mandated, it's just totally negotiable.
That's correct. And this is really enabling language to allow the AG's office to process registrations in which the deposit for extra upgrade dollars could be given to the builder. So the way that the language is written feels a little bit vague, because what it's trying to do is just give power back to the AG's office to say, as part of an Attorney General registration in my upcoming community, I can ask for upgrade dollars up front to be released to the builder. And then the AG will process each application on what they feel comfortable with.
Thank you.
Thank you.
Got it. Thank you. All right. Now, Mr. Adams, Davis. So I assume there was some case that generated this ruling by the Attorney General's office?
Well, the statute has always required, when I say the statute, by the way, Mr. Chairman, my name is J.R. Davis. I'm an Assistant Attorney General with the Consumer Protection Bureau of the Department of Justice, Attorney General's Office. And I'm the person who, for the last 3 years, have been dealing with condominiums and subdivisions. For those of you who have difficulty understanding me, raise your hand, because I come from the extreme southwest part of New Hampshire, which Representative Thax.
No, I'm from Cheshire County. You're.
I spent a long
We don't
time in
talk.
Keene.
Keene.
So,
Okay.
but the statute, both governing land sales subdivisions, RSA 356A, and the statute governing condominiums, RSA 356B, has provided for a number of years that deposits have to be placed in escrow and cannot be distributed prior to closing, with one very limited exception in condominiums that doesn't apply any longer because of change in federal legislation that prevents the banks, prevents any regulated lender. So if the lending is through a finance company that's not governed by a federal charter, there is a provision where payments can be made to be applied to the construction. But the statute covers that. The I guess newness of the issue would be that whenever I started regulating and reviewing the applications, I quickly noticed, and I have a 38-year experience in residential real estate development and condominiums and subdivisions, and we've represented lenders and the whole suppliers and the whole spiel. The first thing I noticed is that I was seeing contracts on very expensive properties that had no provisions whatsoever for upgrades. And I know from my experience, there is no one who builds expensive property, at least. And even in today's world, if there is such a thing as moderate
Change order.
contracts.
A change order.
Yeah, so what I quickly found out was there were side deals. So I started asking, please provide the entire purchase and sales agreement together with all addendums, including add-ons. And that's whenever we found out that there was a practice that was established. I perfectly well understand why the practice, but the statute says deposits have to be held in escrow. So just so it's clear, I'm here on behalf of the Attorney General's office just to provide information. We're not taking any formal position regarding the legislation. We do think that the committee should be aware that as drafted right now, there's an internal inconsistency. If you look at sections 1 and 3 of the legislation, proposed legislation, you will see that it provides for the first time a definition of what constitutes a deposit. Section 1 under the Land Sales Act 356A, Section 3 under the Condominium Act statute, RSA 356B. We've never had a deposit definition because there's never really been that much of a dispute about what a deposit creates. Nonetheless, this proposed legislation has a definition of that. For the first time, it distinguishes between what it calls earnest money deposit. Let's call it good faith money down front so that the seller knows that the buyer's really got skin in the game, versus other deposits for, in order to avoid an add-on list of things, just call them add-ons, change orders, upgrades, whatever. When you look at the sections 2 and 4 of the actual proposal to where the AG's office would have the ability, the way it's written is, we would have the ability to allow prepayment of money that's in escrow, but only the money that has to be in escrow. The proposed definition is saying earnest money is the only money that has to be in escrow. So I don't think that that was the intent of the people proposing the change. If the committee chooses to do anything to recommend to the legislature just needs to be aware that any change that's made is going to have less consumer protection. It may be a fair trade-off, and that's a legislative decision. Because right now, all deposits have to be held in escrow pending the closing. If the legislature decides to choose that, there's any number of ways to do it, but this proposed legislation has 2 alternatives in it that are at odds with each other. Either there are no regulations regarding add-on deposits and no regulation regarding it, or the AG's office has the ability with reasonable conditions to approve them. That's sections 2 and 4. And, again, it's a legislative decision whether to change the statute, obviously. The AG's office doesn't have a recommendation whether it should be done or not, but if it were going to be done, we have no problem with sections 2 and 4 of the statute. We have major problems with sections 1 and 3 because we think that when you put them together, it creates an inconsistency and a logic problem.
Great.
Sorry, didn't mean to make it
Well,
complicated.
that's one of our running jokes in this committee is you ask 5 lawyers, you get 6 opinions. So hence what you're telling us is that this bill is not ready and that we need to sort out this discrepancy.
If the committee was of the opinion that it makes sense to allow for this change so that consumers could both have more choice but still have some protection, as opposed to the absolute protection that they have right now, potentially limiting their choice and causing a cash flow problem for developers. So if the committee decided, a little choice with a little more risk and less cash flow problem on builders is a reasonable compromise, and the AG's office is not taking a position, but if that were the case, that can be done with sections 2 and 4, eliminating sections 1 and 3.
Okay, so let's assume that what we agree to is that we think that any time there is a request by the homeowner to do a change order or do something that requires that builder to have to make a deposit or prepay something, that we think that as long as the builder has disclosed to the buyer that when they signed that change order, that now they have an obligation to pay that. And they can take a deposit right then and there, but it ain't a deposit. It's, well, I mean, it's a deposit, it's a prepayment, and it's non-refundable. If the committee were to agree to that, to just simply say, we think the intent of this is that if the consumer wants that lovely pink tile, then they can't get out of the deal. They have paid for it, prepaid for it, and they're locked into it. Does the bill say that?
I don't think the bill actually says that, respectfully. First off, the issue of non-refundable is not addressed under this bill. And the AG's office, although it prefers not to have non-refundable deposits, we don't object to the non-refundable so long as if the seller is in breach, it's not a non-refundable deposit.
The seller,
The builder,
is.
if the builder was in breach, then the builder does not get to hold on to what otherwise has been termed a non-refundable deposit.
Okay.
So, but that's not addressed. The issue of refundability or non-refundability is not addressed under this legislation. And we don't have a regulation against it. We prefer it not be the case. And we insist that if there is a non-refundable deposit for anything, that it's clear that if there's a breach by the seller, the developer, that the non-refundable provision doesn't apply. The other thing that we require when there is a non-refundable provision, it's non-refundable to the extent that the seller has any money in the game. So an example, going back to our pink marble, it's the example that I always use when I'm talking to the other attorney. So the buyer wants the pink marble. To get the pink marble, there has to be a prepayment to the supplier, and there's a lead time.
Correct.
I as the seller have taken the money. It's in escrow. There's a breach, but I have not yet paid that money to the third party supplier who's going to deliver it. You don't get to hold the money in because you don't have any skin in the game.
I would, to me, the assumption is the builder has taken that money that received from the customer and has taken that money and paid the supplier because the supplier wasn't going to fill the order unless they got some money up front.
And in that scenario, we don't have a restriction on the refundable versus non-refundable. But right now, the statute says all deposits have to be held in escrow.
But that's what we want you to fix.
Well, I don't have that magic wand because I'm just in the executive branch. But
Okay.
the legislature can change it. And if the legislature chooses to change it, we would respectfully submit that sections 2 and 4 do that.
I have been down this path before with the Attorney General's office. It is very, very frustrating that you can tell us what's wrong with it, but you can then tell us that our lawyer has got to figure out the solution to it.
Well, I'm respectfully submitting that if the committee decided to recommend to the House that this bill ought to be passed, our recommended amendment to the bill would be delete sections 1 and 3, because sections 2 and 4 do everything we ask. And I can advise the committee that the language in sections 2 and 4 are a slight modification of what I suggested. So, I mean, we attempted to be part of the process, and we've been dealing with the New Hampshire Home Builders Association regarding this, and that's why we came up with the language that's highlighted in sections 2 and 4.
Representative Ammon has a question.
I do. Thank you for indulging me. Thank you for your testimony. I think I see your point about the deposit definition. So when you see the word deposit in section 2, it automatically does not include that list of change orders, upgrades, et cetera. So that's excluding that.
So it would be self-defeating.
Well, okay, so I think the bill has merit, and I think that it can be fixed. And so in my mind, if I wanted to boil it down, tell me if I'm understanding this correctly. We want the buyer to be able to opt out of the escrow requirement when it applies to change orders, upgrades, et cetera. We want them to be able to opt out with some kind of disclosure, so they understand what they're getting into, but that it eliminates the escrow requirement on those items. Is that the intent?
If this bill was passed with just sections 1 and 3, that would be the result. If it was passed with sections 2 and 4, that would be the result, subject to the conditions that the AG's office imposed, if any. But if you pass the entire bill, the bill is internally inconsistent.
Right.
And it's going to be a quagmire. And just so it's clear, look, I represented everybody in the past in these deals. I understand exactly the cash flow problem here on the one hand, the consumer protection issue on the other hand, and the consumer choice, even though most of us only have two hands, on the third part. So, I mean, if the committee thinks this is a problem and it ought to be fixed, I would respectfully submit the easy way to fix it is delete sections 1 and 3 of the bill. That will allow prepayments for what I call add-ons, so I don't have to go through that whole list of various things, being able to be paid in advance of closing, subject to the conditions the Attorney General's office would impose. And we would impose the same kind of conditions across the board. We just adopt a standard and says, hey, if your language has this, it's just part of what we approve.
That's wonderful.
Further question, you may inquire.
Thank you. I'm just going to be blunt. If I'm doing business with someone and we come to an agreement, why is the Attorney General's office in the middle of that? Like, if I want to do business with another grown adult human, why do we have to get your permission to do it? And maybe you can explain the background.
Certainly. The whole premise of consumer protection is the legislature has decided that there's certain economic actions, not all economic actions, but there's certain economic actions that are so potentially fraught with consumer fraud or misrepresentations or confusion that there ought to be some regulation. So, for instance, to use a different context, in the landlord and tenant law, there are certain statutory provisions under RSA 540 governing landlord-tenant laws that says, you know, a landlord can't do this, a tenant can't do that, and there's a provision in the statute that says the parties cannot agree to something that's contrary to the statute. So there's lots of provisions in New Hampshire law where we say this is fundamentally unfair, or this could be fundamentally unfair, and because there's so much potential fraud and an unequal bargaining in most positions, there ought to be oversight. There are states where condominiums aren't regulated. In New Hampshire, they're regulated. There are states where large numbers of subdivisions aren't regulated. In New Hampshire, they're regulated. If you're going to regulate it, I would respectfully submit there ought to be at least a reasonable likelihood of protection to the consumer. The committee needs to be aware that our state does not require bonding for these projects for the actual units or houses, does not require bonding of the actual performance by the contractor, does not require that the lender complete the project. And so at least making sure that the deposit money is protected is a pretty important protection on behalf of consumers. Having said that, because, you know, when I first started practicing, you know, if you had $2,000 or $3,000 in change orders, that was a big contract. Nowadays, you know, they're six figures. Nowadays, they're 30, 40, and sometimes 50% of the finished contract price. The market, the economics of the situation, and the fact that lenders no longer, by and large, finance on change orders has just completely done away with the way things were. In the past, it wasn't as much of a problem because 15 or 20 years ago, most lenders were still lending on at least a percentage of the add-ons. They'd have an approved list of add-ons, and they'd already know, the builder would already know ahead of time how much finance I can get for that. You can't get that very much any longer, either because it's prohibited depending on what type of registration the bank or financing institution has, or they just won't do it. So there needs to be a change. The question is, do you say there's no longer any protection to the consumer, or do we take a middle ground? That's a legislative decision. But in the event that the legislature decided to take a middle ground, that's why I came up with the proposed language, which was slightly modified, which we have no objections to in sections 2 and 4. So although perhaps inartful, it was an attempt, Representative Hunt, to make sure that we actually could tell you something that we got no problem with this, but it's not our decision.
With section 2 and 4,
2 and 4,
and not one.
not
and three.
1 and 3.
Okay.
One other matter that I might mention to the committee, and this, I know that it's typical in this type of legislation that it's effective within 60 days. If the committee does recommend to the House that this go forward, we would recommend, well, I would ask for the committee to consider whether it ought to happen quicker than 60 days. The reason being is that
No, we would do upon passage.
I have a ton of applications right now where people are asking me to hold up until they find out what's going to happen with this legislation. And I have a ton of applications that we've approved that I've brought to the attention of the developers' attorneys. Hey, there may be something happening this year, so be prepared to file a material change request so we can address this issue. So there's a lot of demand for this. I just wanted to make sure the committee was aware.
We are now, for sure. Thank you very much.
Thank you very much.
All right. As often happens, we get more cards coming in. So Matt Mayberry, Home Builders. Now for the rest of the story.
Exactly. Hello, Chairman. Hello, committee. Thank you so much. My name is Matt Mayberry. I'm the CEO of the New Hampshire Home Builders Association. We represent the 27,000 men and women who work in the residential building trades. We have a solution, Chairman, that I think could work. That's what that little buzz was at the back there. If on page 1, on line 26, if you were to change the word from deposit to prepayment, and then on page 2, line 18, if you would consider changing deposits to prepayment, that kind of closes the conversation of where the Attorney General wants to be and where the chairman would like to be. And we're good with that if that works for you
So
folks.
change deposits to prepayment.
Yes, sir, if you would consider that.
Okay. I'm sure our legal counsel here might have to think about this one for a little bit. But we do everything by subcommittee
Yes, sir.
here. So we will have a subcommittee, and
I'll be available at your request.
and we'll address this issue at that time. And Attorney Davis, I hope you'll be able to make it again. Come visit us again.
I always show up whenever the legislation
There you go. Perfect. Okay.
That's great.
Anybody else who would like to speak on Senate Bill 26? Seeing none, we'll close the public hearing. Senate Bill 26. We move right on to Senate Bill 52, relative to default provisions in New Hampshire trusts. And we have Senator Innes to.
All right. Thank you again, Mr. Chairman, members of the committee. Dan Innes from Bradford, New Hampshire, representing District 7. And this bill is a little bit of a cleanup bill. It's got a lot going on, and there's some great people behind me who can address the technical questions, if there are any, around this. But since the legislature adopted a modern approach to trust law in New Hampshire in the 2000s, we've become one of the leading jurisdictions in which to establish a trust. And it gives us a robust trust services industry that boosts our state's economy. It's good for New Hampshire. The New Hampshire Trust Code has continued to evolve and improve, keeping pace with developments in legal, investment, tax, and fiduciary concepts. This bill addresses default safe harbor provisions in the Trust Code so that the trust settlers' expectations regarding taxation and trust administration are met. And it also eliminates duplicative language. First, the bill amends certain default terms in the trust code known as tax savings clauses to better align with current IRS rules. That ensures the effectiveness of the New Hampshire Trust in terms of federal tax efficiency. Without this backstop of the proposed default language, a settler's goals might be frustrated with the inadvertent exclusion of important terms addressing complex federal estate and gift tax structures. Historically, the trustee was the sole decision maker regarding trusts. In modern New Hampshire trusts, things are a little different, and the role of the trustee may be divided among separate individuals or entities serving as fiduciaries. This bill clarifies that a fiduciary who has discretionary powers over a trust such as a trust advisor or trust protector, serving in a role which was traditionally occupied exclusively by a trustee, is subject to the same good faith obligations regarding their exercise of discretion. Finally, the bill updates a cross-reference and eliminates duplicative language found in other sections of the trust code. And I would ask if I could defer questions to the folks behind me, but if there is a question, I'm happy to try. All right, very good.
Thank you very much for your
Thank you,
testimony.
Mr. Chairman.
The chair will call on Glenn Perlow from the New Hampshire Trust Council. And Heather, you can pronounce it for me.
Thank you, Mr. Chairman, and good afternoon to the committee. My name is Glenn Perlow. I'm a director and general counsel at Jordan Park Trust Company. We've been a chartered non-depository trust company in New Hampshire for almost 20 years. I'm also president of the New Hampshire Trust Council, where I volunteer to represent a number of chartered trust companies and attorneys and other affiliates, all in support of what has been, I hope Chair Hunt would agree, a good exercise in growing businesses in New Hampshire. So we focus exclusively on the New Hampshire Trust Code, trust regulatory laws when that comes up, with an eye towards just maintaining an industry that has grown to over $1.6 trillion with a T in assets managed in New Hampshire. So with me today is Heather Perkins Ogmundson. She is an expert in trust law, unlike myself, so I never travel without her. Senator Innes did a great job of introducing this bill, and so I would encourage you to ask questions if you have them of Heather, and also she'd be happy to explain the nuts and bolts of how this accomplishes what Senator Innes talked about.
Great, thank you, welcome.
Thank you. Thank you, Chairman Hunt, committee members. Again, my name is Heather Ogmundson. I'm just going to walk you through a few of the changes, which there's only a couple, but a lot of words sometimes causes confusion. The first key revision in 814 exclude 564B 8814 includes replacing the word trustee with fiduciary. As Representative Innes had said, the evolution of the New Hampshire Trust Code with the approach to the modern trust administration in general has seen the rise of bifurcated duties, typically preserved that were exclusively to a trustee. This is generally referred to as the directed trust approach to trust administration. By making the replacement here in this context, the fiduciary standard is linked directly to those individuals serving in the directed trust construct, such as a distribution advisor. This fiduciary standard, as you may know, is fundamental when assessing an individual's actions in this context, acting in good faith, avoiding conflicts of interest, prioritizing the beneficiary's interests. The second substantive revision in the first part of SB 52 is the tax savings clause. The language clears up prior ambiguities by providing direct references to pertinent provisions of the Internal Revenue Code and delineates exceptions to those rules. In general, this provision seeks to avoid unintended consequences. So should drafting errors occur that exclude limitations on a beneficiary's removal and replacement powers where a fiduciary has discretion to make distributions. The language in SB 52 limits the removal and replacement of a fiduciary to an independent party, someone who is not related or subordinate to the beneficiary. So looking at this from about 1,000 feet, really, from a practitioner standpoint, this makes sense. If a beneficiary had the power to remove and replace a trustee with someone related or subordinate to that beneficiary, the beneficiary is effectively exercising a power of appointment, a general power of appointment in this context, that would then subject that property to inclusion in the beneficiary's taxable estate. The second and third parts of SB 52 cleans up a cross-reference to 564B 818, which is being repealed in this bill, and we've just substituted that to the reference to 814. 818, everything in 818 is captured in 814. I'm happy to answer any questions.
So for the committee, entertainment, the history of this legislation was when another legislator gave me a hard time about why was Delaware ahead of us when it came to financial instruments? And in working with the Bankers Association, it was a 2-year project that we had a room. We had one time we had a room like this where all the tables. I think we had like over 100 bankers and lawyers are all in one room as we hammered out the with Diane Vickers from the bankers, and we were hammering out all the language. So it is a little surprise, no, that there are little pieces as time goes on that we're fine tuning this document. But nothing else to say is that at least we are out in front of almost every other state. I think South Dakota was trying to run up next to us, but we're out there, and that we actually took what was historically always case law, and we put it into an actual statute, and it's something we can all be very proud of. So, any questions from the committee members? Seeing none, thank you very much.
Thank you. Thank you.
Is there anybody else who would like to speak on Senate Bill 52? Seeing none, close the public hearing. Still behind? Okay. Senate Bill 85, read over the Chenk Bank lending limits. And I've got no cards yet.
Sorry.
Is assume Ryan went out to look and see if Senator Pearl's still around. You flew the coop? Okay. It's okay. Chrissy, you want to come up and...
Would you like me to swap out your sign?
We are very privileged to have the president of the Bankers Association here to introduce the bill for us.
Good afternoon, Chairman Hunt, honorable members of the House Commerce and Consumer Affairs Committee. For the record, my name is Christy Merrill. I have the honor of serving as President and CEO of New Hampshire Bankers Association. We represent 40 member banks who employ roughly 6,000 individuals across our state. Thank you for the opportunity to testify, and thank you to Senator Pearl for introducing this legislation, as well as the Banking Department, who has been helpful in working through these issues. Senate Bill 85 does two things that you should be aware of. It raises the legal lending limit for New Hampshire charter banks from 15 to 20% of capital, with an option to increase it to 25% if the additional 5% is fully secured. Right now, New Hampshire banks can lend up to 15% of capital to a single borrower, but what we have learned is that out-of-state banks that operate in New Hampshire can go up to 20%. Maine, Vermont, and Massachusetts all allow up to 20%. So if similarly situated banks are going in on the same deal, a New Hampshire bank can only go up to 15%, while the other banks may be able to go up to 20%. Our legal counsel researched the legal lending limits across the country and found that 44 states have a legal lending limit of 20% or more, and 32 states provide limits of 25% or more with certain security and department approvals. Obviously, this put New Hampshire banks at a competitive disadvantage. What practically happens today is when a bank starts to reach that 15% cap, they would work with other banks. It's called a participation loan, or a participant in a loan, and they would work with a bank that is out of market. And when that happens, if they're not in market, that could mean that those funds don't stay in New Hampshire. They're going to the state where the bank is located. This legislation would be the most helpful to our smallest banks, and it will help it'll help level the playing field for New Hampshire charter banks, and it'll also improve access to credit. So that's kind of the part of the bill that deals with the legal lending limit. The other thing that the bill does is it changes New Hampshire's de novo period to from 5 years to 3 years, which is consistent with the FDIC. The de novo period is the initial phase for newly chartered banks. And during that period, they have heightened regulatory scrutiny from the FDIC and the New Hampshire Banking Department. We're just trying to align these two standards to alleviate the inconsistencies and help keep New Hampshire attractive as a place to charter a new bank. This will help ensure that New Hampshire remains attractive for starting new banks and reduce regulatory burdens over those additional 2 years. And as part of the amendment in the Senate, it does allow the banking commissioner to extend that period to 5 years for safety and soundness reasons if necessary. We've been really fortunate in New Hampshire, even though we are seeing a lot of merger and acquisition activity around the country, and you are not seeing a lot of de novos. We've been very fortunate to have a lot of de novos here in New Hampshire, and we hope to continue that. Senate Bill 85 will not only strengthen our banking industry and ensure New Hampshire charter banks can compete on a level playing field, but can also incentivize the creation of new banks, and we respectfully ask for your support. Happy to take any questions.
It might have been around long enough to remember it used to be 10% at one point in time, didn't it? It used to be. Am I the only
don't
person in the room
recall
who
that.
remembers that?
I don't know how far back you're going.
I'm probably the only. Glenn, you've been around long enough. Don't you remember the 10%? No. So, oops. Okay, I guess I just admitted how old I am. All right. Great.
you.
Thank you very much. Bankers, department, no concerns? Does anybody have a question to the bank commissioner? Representative Salvi, you have a question for the bank commissioner?
So you guys are lending more money, right? Right now, the capital.
She's not lending. She's the bank.
Her bank. basically.
Oversees the bank.
Okay.
She's not a bank.
She's not a bank. But my
She's the
question
bank
is,
regulator.
So my question is basically, who is going to, what are the things we are trying to implement to manage this risk? Do we have any policy in place?
Yes. Yeah. That's appropriate for you. Thank you.
Thank you, Mr. Chairman. Christy Merrill, New Hampshire Bankers. So if I understood the question, it's what processes are in place to manage the risk.
Yeah.
When we talk about this, sometimes the question of risk comes up. We don't see this as expanding a bank's risk. If a bank specializes in a certain area, they're not necessarily going to change what they do. It just allows them to lend a little bit more. So because banks are heavily regulated, they are examined every 18 months, and risk is something that is assessed by their examiners. So we don't expect any of their risk practices to change. Many banks will have loan committees and loan review. So whenever they have certain criteria within their threshold for risk, and once they have that level of risk, it goes to their committee and they have a group that talks about it. So there are procedures in place. So this would not change the procedures for how a bank manages risk.
It's a follow-up question.
Further question, you may inquire.
Thank you. If the economy goes down, there could be many parameters where things might go south. So if we do not have any modified process in place, how we can basically increase the capacity of giving the loans?
Yeah, I think when the economy goes bad and there's a concern about credit risk or things like that, I think that's where you have a very heavily regulated banking industry, and we have found that the regulators are responsive to that, and they will focus on that. They'll have heightened focus on certain areas depending on what is going on to the economy. So I guess I would say that I think the regulatory framework that's in place at the federal level and the state level works and handles it, and there's not a need for further change. But yeah, I guess that's how I would respond to your question.
Okay, I think time will say that. Thank you.
Yes.
Thank you very much.
Thank
Chris.
you.
Okay. Is there any other speakers on Senate Bill 85? Anybody have any more questions? Close the hearing. on Senate Bill 85. Okay. At least we have one easy one, right? Two easy ones. Okay. All right, last but not least, Senate Bill 1, and okay, we have somebody else testify for her. Okay, we'll open up the public hearing on Senate Bill 164, and Max Taylor will introduce the bill for Senator Riccardi.
Good afternoon, Mr. Chair and members of the committee. For the record, my name is Max Taylor, and I am the legislative aide to Senator Ricciardi. I'm here today on her behalf to introduce Senate Bill 164 FN, legislation designed to protect New Hampshire homeowners from harmful and deceptive real estate practice known as non-titled recorded agreements for personal services, or NTRAPs. These agreements, often marked as quick cash opportunities by out-of-state companies, offer homeowners a small upfront payment in exchange for signing a long-term agreement, sometimes for up to 40 years, for future real estate brokerage services. The issue is that these agreements are then recorded in the county registry of deeds, clouding the title of the home and creating legal and financial complications for not only the original homeowner, but also future property owners. Senate Bill 164 FN directly addresses this practice by rendering NTRAPs void and unenforceable in our state. It eliminates the financial incentive for companies to target granite staters and protects consumers from unknowingly locking themselves into decades-long obligations that could interfere with transferring or financing their property. In some cases, homeowners who want to terminate these agreements have been forced to pay penalties as high as 3% of their home's value, determined solely by the vendor, and have even faced liens if they were unable to pay. This legislation was developed with valuable input from the New Hampshire Association of Realtors, the New Hampshire Bankers Association, and the Consumer Protection Bureau to ensure the bill is effective and enforceable. It includes provisions under RSA 358A2 that authorize the borough to pursue civil penalties if violations occur, reinforcing the state's ability to hold bad actors accountable. New Hampshire has the opportunity to join over 30 states, including Maine and Connecticut, that have already taken steps to prohibit NTRAPs and protect homeowners. We owe it to our residents, especially seniors and vulnerable homeowners, to prevent these predatory practices from taking root in our state. Senator Ricciardi urges the committee to support SB 164 FN and help safeguard the integrity of homeownership in New Hampshire. Thank you for your time. I respectfully ask that you save your questions for the experts behind me. Thank you.
Seeing no questions, thank you very much.
Thank you.
Okay. Let's see. Normally we do departments, so I have Brian Townsend coming in from New Hampshire Department of Justice.
Good afternoon. My name is Brian Townsend II. I am a Senior Assistant Attorney General at the New Hampshire Department of Justice. I am the lead prosecutor of New Hampshire's Elder Abuse and Financial Exploitation Unit. I am here today to speak in support of Senate Bill 164. Essentially what this bill does, and I'll leave it to the real professionals, the real estate professionals behind me to explain more about it, but essentially what this bill does is it makes unlawful these NTRAP agreements for short. The real cause for concern started about 8 or 9 years ago with a company by the name of MV Realty. They were in multiple states. They started entering into these service agreements with a lot of elderly individuals, which is where my issue comes from. And they would record these agreements. They would cloud the title. These individuals would forget that they had entered into these agreements, and then they would ultimately have to pay a service fee of about 3% total of the purchase price of the home in order to get out of the agreement. We review these, or we view these agreements as unfair and deceptive under New Hampshire's Consumer Protection Law 358A. And essentially what this bill does is it classifies them as such. It makes them void and unenforceable and classifies them as de facto unfair and deceptive. And so I'm happy to take any questions.
Service agreement. That is very confusing. Don't we have a better way to describe what these things are?
I think it could be a little more artful, sure. I think the inclusion of the term maintenance in this agreement or in this legislation is somewhat problematic. But ultimately, I think what the statute does is it narrowly tailors by excluding certain agreements, such as insurance contracts and the like. So I think really once you look at the legislation in its totality, I do think you are left with really this NTRAP type agreement as the agreement or as the type of service agreement that this is striking at the heart of.
Well, the reason I say that is that what I've learned so far, it's one of the bills I have done a little homework on. What I learned so far, this is a very unique item that it's done by a real estate, was it MD Realty?
MV Realty.
MV,
yeah.
and they're not actually realtors, are they? They were just
No.
They're
No.
not even realtors.
No, and there were a
Okay.
few other companies too that were doing it, but MV Realty was the big
But
one.
it's limited to just this concept of you're pre-buying who the realtor is going to handle your estate with your house.
Yes, at least in terms of what MV Realty was doing. That's not to say that others couldn't do something similar in terms of either a maintenance agreement or an offer to purchase or sell property.
Well, that's where we get to be problematic because, maybe there really was a person who, it was doing in some kind of arrangement that was appropriate that they get compensation from the house when it's eventually sold, right? That's normally why we have liens on properties.
Sure.
So how are we going to distinguish, who's going to decide whether this was legitimate or not, or whether this was one of these bad characters versus that the person was doing something that really was a good thing for the homeowner?
Sure. Well, I think we evaluate it ultimately under the statutory language, right? So we see if it meets the example set forth under SB 164, whether it's excluded by any part of 164, and then make a determination as to whether it falls in that category.
Okay. In terms of this does not apply to, is that what you're?
That's exactly right.
What you're holding your hat on?
That's right. And before that, whether it's a service agreement that purports to run with the land or to be binding on future owners of interest in the real property, the service agreement allows for assignment of the right to provide service without notice and consent of the owner. And the service agreement purports to create a lien, encumbrance, or other real property security interest. I think, at least from my experience in our discussions with the real estate community, those are not typical of legitimate agreements.
Okay, Representative Spear.
I read there were several lawsuits regarding this, so I read them. And my understanding is besides these real estate representations, it included things like snow plowing. It included a lot of things that we would consider service. These things are wild if you want to see the thing. So it's much more encompassing than just and the lawsuits that happened and passed.
Right. Just who's going to pay for that lawsuit? How is that going to get handled? And the person's dead? Because they don't even know this thing does exist.
They don't even realize that
Knows
they're even
until-
signing up for
so
it.
this is basically whoever's stuck with having the executor of the estate is the one who's going to have to try to figure out to unwind this.
Potentially, but it's also unfair and deceptive conduct under 358A, RSA 358A. And so when that happens, the Attorney General has the authority to file an enforcement action. And it's ultimately a $10,000 fine for each violation of the provision. The person could also be, or the business or entity is also potentially guilty of a misdemeanor offense.
Okay. Representative
So
Paxton.
this is more of a would you believe, but I have run into this, and it is primarily, I mean, it's a scam.
Yes.
It looks like a scam. It smells like a scam. It's when they record something against your property for 20 years, and it's not just elderly, it's people who have limited understanding of how a transaction takes place, and a limited understanding of what they've agreed to. This is not by any measure a regular real estate contract or even a regular contract for services with a property management company. If you're going to hire somebody to plow your driveway, you don't sign a 20-year contract. And it's very undifficult to unravel at the end. And I've had the unfortunate circumstance where I had to do that. And they being the perpetrators of this fraud, count on the willingness of the people at the end to say, look, I just want to resolve grandma's estate. Here's a check, go away.
Would you believe?
I would believe it. But I think that's an important point because I think the proposed legislation accounts for that type of agreement, right? So, which is why it's not overbroad, because it would be classified as something under Section A, which is a service agreement that purports to run with the land or be binding on future owners. And so your normal, typical plowing agreement is not going to be binding on future owners. So if that is something that's a telltale hallmark of a scam, for which we should be looking at these types of agreements as unfair and deceptive.
So, but all these other states, or if there's other states that pass it, they call it a service agreement?
I honestly, I don't know that they call it a service agreement. I think the representative from AARP could probably speak to that better.
Okay.
I don't know that they've defined it in that exact way. I think several of them have, but again, I think that would be a better question for the representative.
And
from
my
AARP.
last question is, have we had one of these in New Hampshire?
I have not seen one in New Hampshire, so all I can say is we now have one.
He
apparently.
claims he's got it.
But at least from speaking with my boss, who is the chief of the Consumer Protection Bureau, we have not received a complaint at the New
Brandon.
Hampshire, Brandon Garrod, we have not seen a complaint at the Consumer Protection Bureau that has alleged this type of conduct. I'm not saying that it can't happen or hasn't happened, and it may just be that people don't want the hassle and they just pay it and they don't know better.
Fair enough. Yeah, Representative Spear. You got to turn your microphone on.
All right. Would you believe that in the lawsuits that I read, they call it an illegal marketing practice as opposed to a service
Illegal marketing
practice?
practice. Jesus, okay. Not much better. Okay, yeah, Representative.
I just, thank you for letting me ask the question. Thank you for taking it. Could you dumb this down for me and just tell me a story about like, a scenario so that, the average person can understand, I don't even know how to set it up for you, but if you could,
Sure.
like explain it.
Well, there was one, I did get a letter of the actual story. I have someone who could tell you.
Okay, that's great.
That might be better.
What happened in Ohio?
Just given that we haven't seen it, but ultimately what it is just sort of a hypothetical. Is an entity approaches a homeowner and says that we want you to sign this document that gives us the exclusive right to sell your property. This document is good for 40 years. If you do not allow us, if you sign this and do not allow us to sell your property, then there's going to be a penalty up to 3% of the home's
But that's not
purchase
necessarily written in the contract, in the lien. That's not necessarily what the consequence was not necessarily.
Well,
written in
well,
there.
sometimes it is and sometimes it isn't.
Okay.
I think that's
The
sometimes
one
it is
I
and
saw didn't have.
And it may be sometimes it is and sometimes it isn't. But then they give the homeowner, I think it's up to $5,000 for that exclusive right. So often these individuals who are strapped for cash, elderly individuals and people with moderate income, it could be anybody of any ages, they'll take that deal not realizing what they're actually signing. Years pass, they sell the property. That entity who they agreed with learns of it and comes back and says, well, now you owe us 3%.
Well, they're going to learn from it when they do the title
that-
search on the property. They
that-
won't be able to sell the property.
That's sometimes they are and sometimes they are and sometimes they aren't. So yeah, they'll have to negotiate.
This is clear. This is clearly messes up the title. I can't imagine any property could get through the title search without this.
And that
popping out.
may very well be true. And that's what we're targeting. But my understanding is some registries of deeds have not accepted them. And so they haven't been actually on the title, but these companies have come in later after the fact and asked for their 3%.
Right. Okay.
So, That's really what I'm getting at.
Shake him down. Okay. Thank you very much.
Thank you very much.
Okay, another unusual one here. We have Catherine Burby from Dover. She is part of the New Hampshire Registry of Deeds Association. Welcome.
Thank you. Hi, my name is Catherine Barabee. I'm president, as you said, of the New Hampshire Registry of Deeds Association. The New Hampshire Registry of Deeds Association does not really take a position on any bill unless it directly affects, you know, the workings of the Registry of Deeds or the office. Oh, I'm sorry. Okay, can you hear me better now?
Yeah.
Sorry. Okay,
Right.
great. So as I was saying, the Registry of Deeds Association does not take a position, you know, on a bill typically unless it actually is affecting the Registry of Deeds office, you know, or the management of the office or something with regard to that. So we're neutral on Senate Bill 164. What we have a concern about, though, is on Section 6 C, where it indicates that the Register of Deeds can decline acceptance of a document if they do not believe that it is fair. So you'd have to look to see if it was fair or unfair. And the Registry of Deeds Association does not agree with that. That's not our role. Our role is to look at the document on its face and to meet the recording requirements according to the statute. I mean, that's really putting us in a position of being a judge to determine whether or not an agreement is fair or not fair. I have spoken with Mike Padmore from AARP, and I think we're in agreement with that, that it should be amended to delete that section of the bill. I did also submit written a letter, you know, that goes into more detail. And I guess at the risk of repeating what's already been said, I just wanted to let you know what our position was. You know, it's with regard to the Deeds Association. Any questions?
Yes, we do. Representative Hammond.
Thank you. In your experience or your members' experience, have you seen this scenario and how often? And
Yeah, I can't say that I haven't seen this. I mean, we have had issues with fraud, and typically what happens is that we still have to record it, the document, but then we send it to the county attorney's office, and they do the investigation and then proceed from there. So, again, if it meets our recording requirements, you know, we are pretty much bound to accept the document and record it. So I haven't heard from any of the other registers that they've actually seen this. Doesn't mean that it hasn't happened or that it's not on the, you know, it's coming down the road, you know, so, but we're always, you know, we're always trying to speak with each other to see if, you know, what's happening. And, you know, there has been fraud. There has been people who have signed documents that, you know, are not accurate, or, you know, they're pretending to be someone who they're not. But again, our role is to send that to the county attorney's office, and then they follow through with that.
Okay, thank you very much.
Thank you.
Okay, Mike Padmore from John Brzezinski from AARP.
Good afternoon, members of the committee. My name is Mike Padmore. I'm the Director of Advocacy with AARP New Hampshire. And I really appreciate Senator Ricciardi for introducing. We are the organization that approached Senator Ricciardi to file this legislation. We really appreciate that. I'm here with Chief John Brzezinski, who's a retired chief of police from Bedford. And I'm going to start by walking through, and I appreciate some of the questions. And so I'm going to try to address some of those questions in my remarks as well. And then Chief Brzezinski will give some final remarks. We also have some volunteers in the room. A few of them will plan to speak as well after I'm done. So I want to talk about just a little bit of the background around this legislation. I think Max did a really good job of talking about what this issue is. Representative Ammon, one of the questions that you had asked was kind of give me an example, of kind of how this might work and maybe play out in practice. And so during the Senate hearing, one of the realtors, Chris Norwood, came and testified. And I want to maybe share a little bit. This was in the notes from the Senate hearing, and I think it was a really good example of why these agreements are bad. And I think we all agree that these agreements are not good. They're not in the best interest of the homeowner. But he told a story where he said MV Realty began using these unfair practices by having 40-year agreements. Even if a spouse died and the title were transferred to the surviving heir, the heir would be required to sign a new contract. If they did not, they would be penalized with a 3% fee equal to the home's value. And so I think that kind of boils down how this does work in practice when you have agreements that are not just running with the homeowner themselves, they're running with the property. And think about all the challenges that can kind of cause as well when you're thinking about if an individual is even trying to refinance down the road and they have a lien that's on their property. And so what I also want to do is walk through the actual bill itself, because we've been working with a number of different organizations on the actual language of this bill. And so we've been working with the New Hampshire Land Title Association, the New Hampshire Association of Realtors, the New Hampshire Consumer Protection Bureau, New Hampshire Deeds, who you just heard from, the New Hampshire Banking Department, the New Hampshire Bankers Association, and the New Hampshire Legal Assistance. And so walking through this, and we've heard from a couple notes so far of some changes that we're looking into and that we absolutely support. One of the things for Mr. Townsend was talking about removing the word maintenance. That's something we would support. I think that narrows this and it really focuses it, makes it a little bit more cleaner, or that we're talking about the purchase or sale of residential real estate. Another one, which Ms. Berube just brought up, which is to remove Roman 6, letter C, that speaks to notwithstanding RSA 477:3-A, a county registrar of deeds may refuse to record an unfair service agreement. We would be happy to strike that. And I think that Ms. Berube outlined, why we effectively statutorily have to, based on their statutory requirements, to record agreements that come to them. Then the final thing, and this was talking with Mr. Garrod and Mr. Townsend over at the Department of Justice, adding to the section, and I want to pull this up, at the end of Roman 5, where it talks about any person who causes or attempts to cause a real estate owner to enter into an unfair service agreement as defined under this section shall be deemed to have committed an unfair or deceptive act or practice as defined under RSA 358-A:2. We want to add a comma, and such agreements would be unenforceable. And in talking with both Mr. Garrod and Mr. Townsend, I think we all agreed that what that does is it just strengthens the bill to very clearly state that these agreements are not enforceable, so that if they are signed, they are not enforceable. So it's just a strengthening clause just to ensure that this cannot be interpreted any other way. These types of agreements, when they meet the requirements that were referenced earlier in the bill, these are unenforceable by nature. And why that's important is because our goal, AARP, is to protect consumers. And what this legislation does is we want to ensure that even if someone is targeted by one of these companies to try to sign one of these agreements and they get talked into signing it, it doesn't make a difference, because this law would say that signature on it makes that agreement is unenforceable, right? Just by nature of this law. And so that's what's important. We are getting directly to the root of this issue, and we're protecting consumers and ensuring that even if they were to sign one of these agreements, it would not be enforceable. And I also want to point out, we've talked about that 30 states, including Maine and Connecticut, have passed laws, have passed this law. This is what we've been working on around the country, because we've recognized that this was an issue that was happening across the country. And what's important is when we've passed these laws in different states, it takes away the incentive. It takes us off the target list, right? if you have a law on the books that is not only making these agreements unenforceable, but in New Hampshire, and Mr. Townsend outlined this, it is a misdemeanor. It is a crime if you violate the deceptive practice. If you commit a deceptive practice, I'll say that. And so that is taking away any sort of incentive for these companies to try to do this practice here in New Hampshire. And so what we found is when we've passed these laws, it is eliminating this practice because it's taking away that incentive. And so let me just walk through the legislation just real quick. I just want to kind of point to a few different things. As you can see, the first section, Roman 1, that is where we talk about the definitions. Section 2, that is talking about the requirements. All of these, excuse me, not all of these, but as you can see, one of the key changes that we made from the original draft was in the first, in Roman 2, where we talk about a service agreement is unfair under this section if any part of the service subject to the agreement is not to be performed within 2 years. So we originally had 1 year, but we've been working with the New Hampshire Realtors Association, and to make this law concurrent with the main law, we felt that it made more sense to make that 2 years. And I think that Mr. Quinn from the Realtors Association will speak to the reason why we felt that was more appropriate. Going to the next section, section 3, that's where we're talking about all of the exceptions. So we did put a lot of thought into making sure that there are some exceptions to this. We don't want to encompass agreements that are not unfair in this. And then section 5, this is where we talk about the enforcement, which I just referenced earlier, talking about adding a section to that, or adding a few words to that. And then the final section is recourse. As we've talked about, if say this happens up here, an agreement is signed, the county registrar's office, they do have to file that agreement. What this does is, if you look at Roman 6, letter E specifically, this is the consumer's how they are able to effectively clean that title, because if this is recorded, it is on their title. And so what that does is it just allows for an individual to have recourse and actually get this officially removed from their title. And so we feel that's important, because just because they're unenforceable, that's great. That is an important part. But if this is on their title, they do need to have some sort of an action they can take to officially remove that from their title. And so let me just see if I have any other notes. I think that really covers my remarks. And so I appreciate the time. I appreciate all the questions that were asked earlier. And I'll pass it over to Chief Brofonsky.
Good afternoon, Mr. Chair and members of the committee. My name is John Brofonsky. I am a retired chief of police in Bedford, where I was chief for 12 years, past president of the New Hampshire Association of Chiefs of Police, and 45 years in law enforcement. Much of the elements of this particular law have already been addressed by Mr. Padmore and the previous folks who testified, but let me bring this around to the point of view from law enforcement as we continue to see a multi-billion-dollar industry that is attacking seniors as well as other folks throughout the country through a variety of fraudulent schemes and fraudulent practices that are defrauding and taking away, literally in the case of many seniors and lower income folks, the last vestige of financial stability that they have in their lives, and that's their home. Oftentimes, these particular fraudulent schemes, and this one in particular, is designed to attack and address those most vulnerable, such as seniors, who towards the end of their lives are desperately trying to stay in their home or preserve that home and or trust for their family members going forward. And these types of schemes prey on those folks mercilessly. And so this particular bill addresses and closes a very important gap here in New Hampshire that would provide a preventative and rectifying mechanism to ensure that this sort of fraudulent practice throughout 30 states and more, because some of these states who may not have necessarily a deceptive practice law in place such as this, they do have similar practices that are prohibited in their real estate laws, rules, and regulations, such as in New York and others. So this is an important law that goes forward. And in closing, let me just say this. There wasn't a week that goes by, and I only recently retired here about a year ago. There wasn't a week that went by where there wasn't some call or complaint involving mostly seniors, but also other folks of all various walks of life, economically, social strata. It doesn't really necessarily target just seniors, but there was never a week that went by that there weren't 1 or 2 or 3 cases involving fraud. Not necessarily this particular type of fraud, but as Mr. Padmore indicated, if we don't build a granite wall here against this type of deceptive practice, it will come. People are thinking about how to defraud people every single day. It's a multi-billion-dollar industry. You've probably gotten texts and messages about your EasyPass account, as well as other types of deceptive fraud regarding parcel packages and so forth that you need to click on, and of course then your identity and your finances are in jeopardy. So this is a very important measure that is narrowly defined and closes that specific gap in our real estate industry. So we hope that you look favorably upon it. From a law enforcement perspective, it's a great preventative measure. And again, it affords the opportunity for folks who fall prey to this type of deceptive practice to be able to rectify it, particularly and clean their land and deed up so that it could be properly handled as they wish towards the end of their lives. Thank you.
Okay. Representative Macklin.
Thank you, Mr. Chairman. Thanks for taking my question. I would assume that if this bill passes, that it would be retroactive. But I can also see a scenario where somebody, let's say they paid $5,000 to get one of these maintenance things on a house. I can see that they would maybe try to come back and get that money if this turns out to be unenforceable. Could something be put in the bill that would prevent that?
Thank you for the question. So I think one of the things that we have looked into and working with the Department of Justice and especially around the country, it being retroactive, I'm not certain about that. Actually, I think what we have seen is that around the country, when states have passed this legislation, some AGs have actually entered suit against these companies as a form of to find recourse for individuals that have signed these agreements. And so perhaps what we could do is work with Mr. Townsend and just discuss maybe that scenario and see if there is additional language that should be added in to address that. And we are very happy to work on, language to tighten this up in any way if folks have suggestions.
Well, I would start with changing the title. And given that I'm a big believer of keep it simple and making an understanding what I'm doing here, I think it should be an unenforceable lien. That's what it is, an unenforceable lien. And now we're educating everybody that you watch out. There are liens that are unenforceable, and that's what this title should be, personally. That's just what I just came up from, but it could be wrong. Just an idea. Okay. Thank you very much. Oh, Representative Cerisa has a real question?
Yeah, thank you, Mr. Chairman. Quick question. So do you foresee lawsuits from the realtors who have paid, they say like sum of 5,000 or what amount to the homeowners, and once you revoke that, do you foresee lawsuits from them?
No realtor ever signed one of these.
No, the companies who,
Yes, you were.
Okay.
You trashed his profession. That was.
Oh, I'm sorry.
That was very inappropriate.
Wrong from the companies.
The simple answer is no, because if we call it an illegal lien, then that's what it is, and so if someone wants to try to enforce it, oh well.
Okay.
I think it's unenforceable.
Okay. Thank you.
All the more reason why my new title is a good name.
And
Okay.
perhaps just to just add to this, when we're talking about the amounts that we have heard for these upfront cash payments, we're talking anywhere from $300 to about $3,000. So we're talking about less than $5,000 is what we're seeing. And I think the way that we have seen this practice play out is that that's effectively sort of a bait. It's like a signing bonus where they want folks to just sign on the line. Here's your cash. Here's your cash payment.
Right. Oh, I'm glad you brought that up because the last that you talked about this 1 year, 2 year thing. So that implies that if someone dies within a year or within less than 2 years, then whoever signed this agreement it will come forward and say. Theoretically, he's going to contact the executor of the estate and say that, oh, by the way, I have this agreement that I'm supposed to be your broker.
Right, and I also think, we should talk more about that, right? Because I think
because that's what that implies to me.
Right.
But tell me if I'm misreading that.
Right. Please.
Yeah, although it implies that, as the good member of the committee, as a realtor knows, that this would not infringe or encumber any legitimate real estate contract. So if it's an illegitimate scam, fraud scam, this would come into play. But the 2 year or 1 year agreement that you may sign with a realtor that's legitimate with respect to listing your house, and I shouldn't say never, but there's normally no fiduciary arrangement there with a realtor to say, sign this a listing agreement and I'll give you $300. That generally doesn't happen. And sometimes in some states it's prescribed. This is not what that is. Those 2 year agreements are legitimate agreements that the realtor.
Well, that's, I guess, why I don't understand what the purpose of this paragraph then is.
Because our main concern is where we found these very long-term 40-year agreements. And so I suppose probably the best way to describe this is that you have in these agreements, they're written in there 40 years, right? And so I think, and I'll defer to Mr. Quinn in talking about this, but I think, again, the reason why we landed on 2 years is because, and I think this touches on what Mr. Brofonsky just said, is that we have not found legitimate realtor agreements that are any longer than 2 years. And so I think
But
that's...
I've never seen a real estate agreement that ever had a lien.
I think what might be better is to maybe defer to Mr. Quinn to answer some of these questions, who has maybe seen some of these agreements.
Okay.
Oftentimes, what occurs, as realtors know, is that as a listing agreement comes up for termination and the house hasn't sold, they'll come back to the homeowner and ask them to reauthorize an agreement or an extension. So those are the types of normal real estate listing transactions that are.
Well, right. I mean, every real estate agreement I've ever seen it's effective upon signing. There's no wait a year before we do anything or wait before something happens. It's upon signing, and it's usually an exclusive that you can't have any other realtor. You've signed that one agreement, and you have to wait till it expires before you can go shop up for another realtor.
That's correct. And typically those service agreements or listing agreements have a specific date.
Yeah.
That's
upon
prescribed.
signing.
And sometimes those dates are they vary because the seller, negotiates the time frame for the agreement.
Okay. We will figure this out in subcommittee.
I have a question.
Yes, Representative Selby.
Thank you for taking my question. Thank you, Chair. I have a question regarding, have you talked to the county registers and the court? Because in order to enforce this regulation, they will have more work, and how they are going to manage that work, and what is the process? Did we guys talk to them?
So referencing the county registrar's
Yeah.
office. So I think Ms. Barubi, who just spoke, represents New Hampshire Deeds, who represents the county registrars. And so perhaps we can follow up with her. But we have spoken. I spoke with Ms. Barubi about a week or two ago where we talked through this legislation. And I think she outlined just that one concern in the legislation around them being able to refuse agreements. And so that's something
She
that-
does not. They do not. They're not
Right.
in the business of refereeing a recording. When you bring a recording in, As long as you do it on two separate pieces of paper, don't put it on the backside, which I did the first time and got yelled at. But as long as you do it right and by their rules, then they will record it no matter what. That's why we have to put language in here to then instruct a court to go ahead and clear title.
But their administrative work will increase for sure, right?
Say it again.
Their administrative work will definitely.
Their administrative work is nothing. They're totally out of the picture. They simply recorded it. It sits that are out there. That is true that they upload it and whatever, but that just, that's the nature of their business. But no, and then of course they would record the release once a court ordered one.
Thank you.
Okay.
Of course, thank you.
Thank you very much. Okay. All right, Bob, since you were used in vain.
Good afternoon. My name is Bob Quinn. I am the CEO of the New Hampshire Association of Realtors, and we do support the bill. We would agree that they are fraudulent and deceitful in their intent, and agree with the testimony that was offered prior to mine. I will tell you that MV Realty, the company in question, does not operate in New Hampshire. I confirmed that with the Office of Professional Licensing. And until today, with Representative Thaxton, I had been trying to ascertain from our membership, has anyone ever heard of such an agreement before happening in the state? And nobody is aware of one. I think arguably if you were, and just to clarify, all realtors are real estate licensees. Not all real estate licensees are realtors. All right? So there's a difference. You're a member of the National Association of Realtors if you're a realtor. If you are engaged in a practice like this, we think that already under RSA 331A, the Real Estate Practice Act, there are prohibitive conduct requirements within that, and we believe that this would fall under that prohibited conduct. And if you did engage in such activity, your license would be in jeopardy and potentially pulled by the New Hampshire Real Estate Commission. I would also, to answer the chair's question, there are a number of states who have approached this issue in different ways. In Maine, they refer to them as unfair agreements to list residential real estate. In Colorado, they're broker engagement agreements. So there are a variety of ways to kind of get at the same issue to prohibit this practice. And we are more than happy to work with the subcommittee and AARP and others on any language that you might feel is more appropriate. Thank you very much.
Any questions? Seeing none?
Thank you.
Okay, I have one card left here. I have several people from, I assume we're all AAR people. Mary Roberts from Manchester, Pat McDermott from Hooksett, and Sharon Hinckley from Merrimack. Not when you turn the mic off.
All right. So good afternoon. My name is Mary Roberge. I live in Manchester. I am a volunteer with AARP New Hampshire, and also I'm an AARP New Hampshire fraud fighter. As a fraud fighter, I focus on making people aware of the various frauds that can be harmful to everyone. I'm having this testimony because I'm requesting that the committee approve SB 164. Unfair service agreements are implemented by certain predatory real estate brokerage firms who offer a property owner upfront cash to sign a listing agreement. This upfront cash can be as low as $300, and the agreement can be effective for up to 40 years and is tied to the signer's property because they are recorded in the property records. Not everyone is an expert at reading these agreements, and they can be confusing. As a dedicated fraud fighter, fighting fraud, I know the importance of preventing unfair and harmful practices that take advantage of people, and these practices can be devastating. SB 164 will make these agreements unenforceable. They will prohibit the recording in property records and create penalties if the agreements are recorded, and provide for the removal of these recordings and create a mechanism for recovery of damages. And yes, I know that's a lot in one sentence. But thank you for listening to me, and I am again requesting that you approve SB 164. Thank you very much.
Thank you.
Good afternoon. My name is Sharon Hickey, and I reside in Merrimack, New Hampshire, and I also am a volunteer for AARP New Hampshire. I'm here today to express my support for Senate Bill 164 and urge you to do the same for this common sense bill. This bill is about prevention. Preventing predatory practices whereby a real estate brokerage firm offers property owners a very nominal upfront cash, sometimes a very small amount of money, in exchange for a listing agreement to occur at some point in the future. These agreements are liens on their hard-earned property. Many, it's their only asset, or at least a substantial portion of their wealth. And it binds the property owner to a service agreement for many years in the future, sometimes as many as 40 years or maybe a generation. This practice preys on individuals who may not fully understand the agreement and its long-term implications, and it binds owners as well as potentially their heirs into penalties when an owner attempts to sell or transfer their property. The agreements encumber the property and will stand in the way of an owner trying to transfer or maybe even refinance their property. Most folks do not have the expertise to review a sometimes confusing contract, and the benefit of legal counsel may just be out of reach for them. This bill is aimed at preventing scams and supports consumer protection by making any existing contract unenforceable, and prohibit the recording of these contracts at the county's registry of deeds, and creates a penalty if the agreement is recorded. In closing, we urge you to support this bill and join alongside the New Hampshire Board of Realtors, as well as the New Hampshire Attorney General, as well as New Hampshire law enforcement, to prevent potential scams upon our society by banning these predatory agreements. Thank you today for your attention.
Good afternoon. My name is Patrick McDermott. I live in Hooksett. I am the volunteer state president for AARP New Hampshire. I'm here representing our 212,000 members in the state of New Hampshire. That's right, 212,000 AARP members in New Hampshire, and about 150 very active volunteers, some of which are sitting behind me wearing red, of course, and next to me. So I'm here to speak in support of Senate Bill 164. I'm in agreement with what most everyone has already said, and I won't repeat everything, but I did want to emphasize a couple of points. There are no organized groups that support these service agreements. Nobody supports them. Some people are neutral, but no one supports them. These agreements can be in effect, as we've heard, for many years, for a long period of time, impacting homeowners and their families for generations, literally. And finally, these agreements provide very little value to the homeowners in the way of benefits, and can cause a great deal of harm, as we've heard many times already, to some of Granite State's most vulnerable citizens. I urge you to support Senate Bill 164 that outlaws this unfair practice. Thank you very much.
Thank you. Is there anybody else who would like to testify on Senate Bill 164? Seeing none, I'll close the public hearing and stay tuned for the subcommittee.